Good day, class. Today's lesson will be about call and put options. Call and put options are forms of derivatives like future contracts. Derivatives are agreements that have value based on an asset. The value of the derivative is based on the fluctuating price of an asset. Derivatives are good ways to minimize risk, and so call and put options are means to protect businesses from the change in the value of foreign exchange, which can undermine their profits. The following are the important elements of currency options. Number one, premium. This is the price of the option or the cost of entering into the agreement. Number two, the strike price, also called exercise price or the execution price. It is a predetermined price. Number three, spot rate or the current exchange rate. Number four is expiration, the expiration date of the contract. Let us understand call options by having this example. A Filipino firm purchases goods or imports them from the US and is required to pay in US dollars within 15 days. The Philippine firm is worried that the peso will weaken, making the US dollar expensive from 50 pesos to the US dollar to 58 pesos to the US dollar. The company remedy is to purchase a call option with a strike price of 50 pesos and for a 2 peso premium. This way, they will be able to purchase dollars at 50 pesos regardless of the spot rate. So with the graph, let us illustrate the situation of the firm when buying a call option. You are probably familiar with the hockey stick shape graph from our textbook, and if you are familiar with stock options. When the firm buys a call option, it enters into an agreement with another entity to buy dollars at the strike price or the predetermined price within a given period, usually 15 days or 30 days. So in this case, within 15 days, the firm can buy dollars from the entity for 50 pesos, no matter what the spot rate is in the market, even if the dollar is currently selling higher in the market. Now here's the catch. The seller will, in order to agree with the contract, will charge a fee, also called a premium. In this case, the premium is 2 pesos. Now the graph illustrates the advantage or disadvantage of the buyer. If the spot rate now becomes 50 pesos, the firm can now exercise the right to buy. But this price is not ideal to them, remember, because they lost 2 pesos. When you take into account the premium of 2 pesos, remember the firm paid for this right. So at 50 pesos, it is like the value they're getting is only 48 pesos. Ideally, the firm should wait for the spot rate to be at 52 pesos per US dollar so that they can break even. It doesn't mean they get the 2 pesos back, but when the spot rate is at 52 pesos, in fact, as the spot rate goes further beyond 52 pesos, this benefits the firm more, and they will feel more the weight of the bargain of being able to buy cheaper compared to the market. This is signified by the blue line shooting upward to the right. As the dollar becomes more expensive, the more it benefits the firm. So the more they have a bargain. So think of this line as the gain or advantage of the firm. When the spot rate is below 50 pesos, they lose the 2 pesos and any benefit. So when the spot rate is 47, 45, or 35 pesos per US dollar, they lose the 2 pesos, signified by the straight line on the hockey stick here. And so the 2 pesos here is in parentheses. Consequently, they can now disregard the option because they can buy cheaper than 50 pesos in the market. Now, on the other side of this call option is the seller's situation, represented by the mirror image of the buyer side graph we had earlier. So this is like an upside down hockey stick. Here, given the price of 50 pesos, the strike price of 50 pesos, if the spot rate is below 50 pesos, the seller gain the 2 pesos because they get to keep this premium. But beyond 50 pesos, they lose something, and that is the opportunity to sell their dollars at a higher price. In fact, as the spot rate goes further beyond 50 pesos, the more they feel the disadvantage. If the spot rate is below 50 pesos, they keep the 2 pesos, represented here by the straight line. And you notice that the 2 pesos here does not have any parentheses. Now for put option, this time we have this situation. A Philippine firm exports air conditioners to the US and will expect payment to be in US dollars within 30 days. The spot rate of the US dollar is 50 pesos. The Philippine firm is worried the peso will strengthen, making the US dollar price to fall from 50 pesos per US dollar to, example, 48 pesos per US dollar. In this case, the Philippine firm's remedy is to purchase a put option with a strike price of 50 pesos for a premium of 2 pesos. This way, they will be protected from a loss as they will be able to exchange dollars at 50 pesos regardless of the spot rate. Again, we begin with the buyer's side, but this time the firm is not buying currency, but will be selling currency as an option. So another party will be buying the currency from the firm before expiration. So again, when spot rate reaches the strike price of 50 pesos, the firm can have the option to sell. So even when the exchange rate falls lower than 50 pesos, they are able to sell their dollars still at 50 pesos. The blue line shooting to the upper left signifies the benefit or advantage that they gain for being able to sell at a higher strike price of 50 pesos, even as the peso value of the dollar becomes cheaper in the market. This time, notice that they break even at 48 pesos because they have to consider the 2 pesos premium payment. The straight line of the hockey stick is the 2 peso premium for the option, which they tend to lose if the spot exchange prices above 50 pesos. So you see the 2 pesos here is in parentheses. Consequently, they can now disregard the option, or they can now exchange dollars in the market at higher rates. Now on the other side of this put option is the seller's situation, represented again by the mirror image of the buyer side option graph seen a while ago. Here, given the strike price of 50, if the spot rate is above 50 pesos, the seller gains the 2 pesos because they get to keep the 2 peso premium. So this is represented by the straight line. But as the spot rate falls below 50 pesos and further, they lose a lot more, and that is the opportunity to buy dollars at a cheaper price. In fact, as the spot rate goes further below 50 pesos, the more they feel the loss and the disadvantage. By the way, it is also interesting to note that the upper half of the graph represents the gains of the buyer and seller, while the bottom half represents the loss of the buyer and seller. Now you might be thinking, options seems to be similar to future contracts. What could be the difference between the two? In forward contracts, there is an obligation to buy or the obligation to sell. So in other words, if you are the firm, you have to buy or you have to sell the currency. Okay? No ifs, no buts. In options, there is no obligation to buy or sell. So, in options, you have the option to buy or the option to disregard the agreement. In other words, in options, the firm has the option to execute or dishonor the agreement. And where can firms purchase currency options, both call and put option derivatives? Here in the Philippines, there is no legal agency that sells this kind of derivatives. No? But everyone is free to enter into this kind of agreement through international brokers. No? Actually, even if you look online, there are many brokers or trading platforms, no? International trading platforms, wherein you can engage in this kind of agreements or enter into these kinds of contracts. In the US and in the United Kingdom, for example, the stock exchange sells currency options. So that ends the topic on currency options. If you have any questions, please do not hesitate to message me. You have a nice day, stay safe, and God bless.